Well, I should say that I might have bitten off more than I can chew with that title, Demystifying a Whole Term Sheet. That's probably more than I can do in 15 minutes or that I can do at all. So lower your expectations a little bit, maybe. I usually like to start out with a good lawyer joke. My favorite one, I hope I haven't said this one before, but this kind of inoculates me against the lawyer joke stuff. I'll just tell you one and get it over with. A fairly young lawyer passes away. He arrives at the pearly gates. He's outraged, as lawyers are wont to do. And he tells St. Peter, there must be some mistake. I'm much too young. I'm only 51 years old. St. Peter looks down a little confused at his notes, and he says, well, that's strange. According to your billing records, you're at least 93. And people tell a lot of lawyer jokes, but I think they would tell fewer lawyer jokes if they had met any venture capitalists. And we'll talk a lot today about venture capitalists and a little bit about lawyers, a lot about term sheets, and hopefully there will be something useful. Let's see, clicker, there it is. Hopefully something useful, especially for the founders who are probably looking forward to someday receiving a term sheet. The idea is that it's a good thing to be able to understand what's in the term sheet. You'll of course have competent legal counsel to represent you and guide you through the process, but a founder who understands what's in the term sheet is going to do his company a lot of favors, his or her company a lot of favors through the process. So that's just an example term sheet there, kind of background. There is a lot of typically information asymmetry when you talk about term sheets. VCs, of course, know what's in the term sheet. They drafted it. They know what everything means. And then as a founder, you receive it and you're like, okay, this is awesome. I've been waiting for this. What is this? What's in it? What are the hidden landmines in here that are going to affect my company? What is a term sheet? It's really a blueprint for the final deal structure. It's not a legally binding promise to invest on the part of the VC. The only legally binding elements of a term sheet are the confidentiality provision and the exclusivity and no-shop provisions, typically. So meaning, don't talk about what's in the term sheet, and for a period of either 30 or 45 days, the company's only going to deal with this VC. That's the exclusive provision. Those two things are binding. Everything else is just kind of forward-facing. Hopefully we do a deal, but we realize that due diligence is still ongoing, and we've got to negotiate some key terms. And my goal today is just talk about some of those key terms, certainly not all of them. Hopefully some of the ones that get negotiated a lot, to maybe clarify the VC's perspective on certain things and the founder's perspective. I've kind of broken them up into two categories, economic terms and governance terms. We'll start with the economic terms. And I chose them kind of, this is kind of a basic one. You probably understand this already, but VCs are going to get preferred stock. They're going to have preferences over the common shareholders. That's to kind of compensate them for the fact that they're putting cash into the company, usually a lot of cash, but they don't have control. They're always buying a minority stake in the company. Founders and employees will have common stock. Big one that everybody focuses on, investment amount and valuation. The term sheet's usually going to have a statement that along the lines of the VC is going to invest a certain amount of money in exchange for a certain percentage in the company that they want to own. If they don't clarify in the term sheet whether that's a pre-money or post-money valuation, clarify that immediately, because it can make a big difference. Of course, founders are always eager. They want to be able to brag to their founder friends, their entrepreneur friends, I got a $50 million valuation, I got a $20 million. They want it to be as high as possible. It's a point of pride with them, and that's understandable. You've put a lot of work into your company. You want that to be reflected in the valuation that you get from the VC. But you should work some caution into that. Don't over-negotiate. If you end up with a valuation that's artificially high, you could have some pretty negative consequences down the road. You could, in your next financing round, you might get a lower valuation, and that's called a down round. We'll talk a little bit more about it, but it's a really bad development for a company. So you don't want that to happen. Better to start out with a lower, more realistic valuation in the first round so that you can grow. You want that trajectory. Of course, the VCs are going to always want to negotiate for a lower valuation so they get more shares for the money that they put in. On the topic of the down round, this is another important economic term that will often be in the term sheet. It's anti-dilution protection to the VC, to the preferred shareholders. It provides some protection to them in the event that the company later raises money at a lower valuation than they received when they put their money in previously, a down round. There are a couple types of anti-dilution protection. There are a few of them, but I put two in here. The full ratchet is the most protective to the VCs. It basically results in, well, I'll just give you an example. If a VC put money initially in at $10 per share in the first round, and then there's a down round where the subsequent VCs are coming in at $5 per share, the original VC would basically, in effect, get a grant of double its original shares. And all of the dilution resulting from that will go to the common shareholders, the founders and the employees. So it's a really bad outcome for the founders and employees. Good to avoid it, again, by getting a realistic valuation for the first time and then making sure your company grows and you get a higher valuation. Of course, in any round, there's going to be dilution to everybody because you're issuing more shares. The shareholders are going to own a smaller percentage of the company. That's normal. But when it's an up round, it's easier to, I guess, swallow that kind of dilution because although you have a smaller percentage, you have a smaller percentage of a growing valued company. The broad-based weighted average is much more commonly seen where there is anti-dilution. It's the formula is complicated, but it basically weights the size of the two rounds that are being compared, and it results in some anti-dilution protection to the investors, but a little bit less dilution to the founders. So I would say the takeaway here is if you get a term sheet and you see full ratchet anti-dilution protection, probably should be a little bit of a red flag, might be something you negotiate. Maybe you can give a little bit on valuation and change the kind of anti-dilution protection because, again, the full ratchet would result in a lot of dilution to the founders. The next one is really important also. Liquidation preference. You've probably seen this. You've probably heard about what these are. This determines who gets their money back first in a liquidation event. And a liquidation event could be a good thing, could be an acquisition at an awesome valuation, awesome price, or it could be a dissolution of the company. Either way, there's going to be funds distributed among the shareholders. The most common liquidation preference that you see in a term sheet is going to be 1x and non-participating. The 1x means that the investor, the VC, is going to get the 1x multiple of its original investment amount back before any of the common shareholders participate in the distribution. That multiple could be 2x, it could be 3x, so they would get twice their investment amount, three times their investment amount before the common shareholders get to participate in the remaining proceeds. Non-participating or participating, that refers to whether the VC, after they receive their multiple of their original investment amount, whether they then participate, convert their preferred shares into common and participate alongside the common, or they don't. Like I said, the most often seen preferences right now is 1x and non-participating, which is pretty company-friendly, pretty founder-friendly. With the market changes, we might start to see multiples go up. You might start to see more participating preferred shares. But for right now, I would say if you see something other than 1x non-participating, that should at least give you some pause as a founder and maybe trigger some concerns. Non-participating, just to close this out, it means that the VC can choose to either get its multiple of the liquidation of its original investment price back, or it can convert its preferred shares to common and participate alongside the common. So whichever one is more favorable to the preferred, they have that option, but they don't get to double dip. I think this is the last economic term. This is the employee stock option pool. This is the pool of shares, common shares, that's set aside to incentivize key hires for the company to help grow the company over time. VCs are going to look really closely at this. They want to make sure that there are enough shares set aside by the company to hire all the people that they're going to need to hire, especially in the next 18 to 24 months before the next funding round happens. VCs don't want to be diluted by having to add additional shares to the pool, so they're going to always overestimate. The common size of a pool is 10 to 20%. Founders that look at that and say, well, that's diluting me quite a bit. The way to counter that is to come up with what's called an option budget. Option budget is a list of the key hires that you're going to need to make in the next 18 to 24 months. You should list them by position and then how many options, how many shares you're going to need to give that person in order to incentivize them to stick around and help grow the company. So a founder who does that work and puts that time and effort in is going to be in a good position to be able to negotiate down. Maybe the VC came in with a 20% pool. If the founder has a really persuasive and well thought out option budget, maybe the VC can be talked down to a 15% pool. You just have to have a good basis for it. Okay, governance terms. Governance is basically who determines what happens with the company, who controls the company, who makes what decisions, what kind of vote has to happen, and who gets to vote. The first topic there is the board of directors. The board, before I get into the slide, the board's main role, especially early on, is to hire and fire the CEO, hold the CEO accountable. And we'll talk a little bit more about that. That's maybe not the most pleasant thought for a founder, CEO to think about, but that is the board's job. Early stage financing rounds, you'll often see in a term sheet a board composition that looks like this. The board is going to be the CEO, and it'll usually say the current CEO, and it won't say the founder's name necessarily because you want to have the CEO on the board. The founder might leave, step away from the company. You don't want to be stuck with somebody on the board who's not engaged and involved in the company. So the term sheet will probably say something like the current CEO, initially whatever, fill in the blank, Bruce Hassler, be a great CEO. Could be a CEO on the board with the lead investor representative and then a mutually agreeable independent director. It's probably somebody who's not a shareholder, so isn't aligned with preferred or common, but would be independent and be fairly neutral. I want to give a quick cautionary tale. A lot of founders will be inclined to say, well, I'm representing the common shareholders. I started this company. I want to make sure I have control of the board, not just a majority of the shares, but control of the board as well, which is understandable. But sometimes, like we've talked before, there are unintended consequences. An example happened a few years ago with Uber. At a certain period of time, they had an 11-person board. There were 4 vacant seats. 3 seats were occupied by Travis Kalanick, the founder, a co-founder, and an early employee who was friendly to the founder, friendly to Travis. The VCs had 4 seats. There came a time, though, when the VCs realized it was probably better for the company to move on from Travis. But the problem was Travis had the right to fill the 4 vacant seats with whoever he wanted. So he knew that if the VCs tried to remove him, he could fill those seats immediately and win any board vote. It ended up dragging on for a little bit of time. There were lawsuits involved until he finally was persuaded to step down. So there could be unintended consequences of a board that is controlled too heavily by the common shareholders. A good rule of thumb, just keep the board small, especially initially. Because with every subsequent financing round, the lead investor is always going to insist on a board seat, and you may have others that you want to bring onto the board as well as time goes on. If you start out with too big of a board, it's going to get unwieldy, and it's going to prevent subsequent investors from coming in because they won't have as much of a role. This is a good quote that kind of proves that point by hyperbole. The chairman of Fiat, Giovanni Agnelli, a board should always have, I won't say this with an Italian accent, maybe somebody could, that would be entertaining. A board should always have an odd number of members to avoid split decisions, and 3 is too many. I'm not a math expert, but I think he's saying there should be 1 on the board, and probably he thinks it should be him. But the point is, keep the board small initially. Another governance provision that's worth talking about is that, and a term sheet will almost always include these, is protective provisions. Again, protecting the preferred shareholders because they don't have control. They don't have a majority of the shares of stock in the company. So things like this, where shareholder approval is required for certain decisions, like the ones listed here, and that shareholder approval would have to include a majority of the preferred shares, the VC. Things like amending the certificate or the bylaws, liquidating or dissolving the company, changing the number of directors on the board, changing the number of shares that the company is authorized to issue. And then protective provisions can also include board approvals that would require the director representing the preferred shareholders, the VCs, to be as in the majority for those decisions. Things like incurring a certain amount of debt, changing compensation of executives and hiring them and firing them, and changing the size of the option pool. Those are things the VC is going to insist on, and they're often negotiated. The founders might say this is a little bit too protective. Let's do some give and take here. But these things are going to be requested by most VCs. Another really key one that you'll see, because of the VC model, they're going to want to continue to participate in future rounds of the company, especially ones that come in early. You come in a seed round or a Series A round, they're going to want to preserve their right to participate in future funding rounds, at least at their pro rata stake in the company. Those rights are usually given to what's called a major investor, which is defined in the term sheet at a certain investment amount, $500,000. You put in $500,000, you get a whole slew of rights, including the right to participate pro rata in future financing rounds. A couple more here. Stock restrictions. These are restrictions on the common shareholders' ability to sell their stock outside the company. Right of first refusal is where, let's say, a common shareholder, a founder, early employee, wants to sell her shares to a third party. But she'll go negotiate that deal with the third party, but before she can actually sell, she has to offer the shares at the same price to first the company. If the company passes, then she has to offer the same shares at the same price to the investors. And then if they waive it, then she can sell to that third party. So you can imagine that a third party buyer is not going to want to put a lot of time and effort into trying to buy these shares if she realizes that the company first and then the other investors are going to have the right to take that deal out from under her. This gives the company and the investors control over who owns stock in the company. A lot of founders look at this and they think this is a big restriction on my ability to freely contract and do what I want with my equity, which is normal. It's understandable. But this probably isn't something that most founders should push back on. It's seen as a good thing for the company. It keeps the cap table stable. It allows the investors and the common shareholders to stay kind of yoked together. We're in this together. There's no getting out. We got to make this company grow. So that should be the attitude. The co-sale agreement's kind of the inverse of the right of first refusal, where if there is a sale by a common shareholder to a third party, the investors will have the opportunity to participate in the sale up to their pro rata ownership amount. And that, again, is going to, why is a shareholder even going to be incentivized to do that? Because I want to sell 50,000 shares, but all these investors are going to be able to sell alongside me at the same price. Is it even worth it? But again, VCs are investing in founders. The VCs want to make it difficult for the founders to leave. They want to keep them involved and incentivized and motivated to grow the company. So that's kind of the bottom line. These restrictions are intended to maintain that alignment between the founders and the investors. Founder vesting. I think this might be the last one. Founder vesting, from the VC's perspective, again, they want to keep the founder involved in the company. They're investing in that founder. They believe in this founder and want them to stay involved and grow the company. The founder is going to say, I'm already done vesting. I've been working in this company for 4 years. I've already vested my shares, and I'm not interested in imposing more vesting on the shares that I've already earned. Both of those positions are totally reasonable. They're understandable. But usually you can negotiate and come to a compromise. A common compromise is that the company will grant an additional set of stock options to the founder that will vest over 4 years, 3 years, whatever, and keep that founder involved and motivated to grow the company. You can also introduce vesting acceleration for the founders, additional shares to where if there's a change in control, that vesting would be accelerated and they could participate to their full ownership in the company. And there's single trigger and double trigger acceleration, which single trigger is less normal. If you see that, it's a little bit too founder friendly. VCs probably won't put it in a term sheet. If there is any acceleration, it'll be double trigger, meaning the vesting is triggered by both the change in control of the company and the founder or the employee being let go by the acquiring company. When both of those things happen, the vesting accelerates. All right, that was it. Hopefully that wasn't too painful. I know it was not as exciting as when the video guys were up here showing awesome videos, but if there are, and I probably took too much time, but happy to try to answer a few questions if there are any. And again, wait for microphones to come.
I wanted to know, what are some of the most common reasons why a board of directors would want to let go of the founder?
Yeah, good question. I mean, we can use our imaginations. The company is not performing well. The CEO is the one who's responsible, first of all, for the performance of the company. Maybe they need to go in a new direction. If there needs to be a pivot, and the current CEO doesn't have the background for the needed pivot. Lots of reasons. Yeah, I don't know. I hope that is helpful. Thank you.
First of all, Joel, you'll be hearing from my attorney about that venture capitalist joke.
All right.
No,
I thought I was your attorney, Bart.
You'll be hearing from yourself. You said earlier that term sheets are not legally binding, but what are the kind of the ethics if a term sheet is proffered, but then why wouldn't a term sheet that's been given be followed up on?
Yeah, that's an interesting question, and this comes up all the time, but a term sheet's given after there's been some amount of work done between the investor and the company. There's been some amount of due diligence, but there's still a lot to do. There's typically still looking through the company's finances, through the legal documents. The VC is still evaluating the company, and at the same time, the company is evaluating, is this VC going to be a good partner? Do we want this group on our cap table? So there's still a lot of due diligence to be done. There's a lot of negotiating to be done. So it's not great for the term sheet to be considered binding before all of that work is completed, I would say. Good question.
Why don't we do one more
I
here?
look forward to talking with your lawyer, Bart. He sounds like a great guy.
So we got a term sheet like a year ago from a company back east that didn't end up going through. But in their term sheet, they had a no-shop clause for 60 days. Believe it was 60 days. But I come to find out later that they were shopping around other similar platform or other platforms that were kind of in the same space as us. And I felt a little bit gypped on that we weren't allowed to go and shop around and discuss that kind of thing. And so I wonder, should we have pushed back on that? I mean, it feels very one-sided to have a no-shop clause from a VC firm.
Yeah,
and
to lock you up for 60 days.
Yeah.
Yeah.
So,
No.
I mean, what's your thought on that?
No, I think you're right to feel that way. It's understandable. I think it's kind of the way that it is. The VCs just have a little bit of leverage. The best scenario for a company is that you have more than one VC that's engaged, and they're both of them are really motivated to give you an awesome term sheet. Otherwise, the leverage is kind of on the other side, typically.
So if you receive one term sheet, though, can you accept other term sheets from other organizations that you've been working with?
No, after you've signed it, that no-shop clause will probably kick in for a 30-day, 60-day, 45-day period. But before then, you can engage with as many VCs as you want, and if you get a couple that are really interested in you, you'll probably get a better valuation, you'll get better terms, and you'll have a lot more leverage. Yeah, thanks.
Okay, thank you so much,
Thanks,
Joel. I don't know about you guys, but I feel demystified. Anyone else?